Seb, there's lots of commentary around the theme of fees. Where are we now with this debate?
There isn't a clarity within the industry, as there are in other sectors, around the pricing that you could compare from institution A to institution X. So what we often find is when people debate fees, they're all coming from very different points of reference. In broadest terms, taking all of that into account, there are some issues with regards to fees. Firstly, in segmentation terms. Most financial institutions are going higher up the wealth chain in terms of their asset levels. So they want family office clients, ultra high net worth clients. That's fine, but there are two issues economically. One is that there are less customers in that space and there are more people challenging for them. So there's a concentration and compression. And two is that those types of clients are implicitly very in tune to actually getting lower fees, and that has direct context on margins. So actually, arguably, they're the least attractive sector to go after from a financial perspective. The most attractive sector is where there are the most clients, who tend to accept a higher fee schedule because they know they don't have the buying power, different from the family offices. They also tend to accept that they can accept, let's call them packaged or comparable solutions that everyone else can buy, fair enough, and so therefore they'll pay for that rate, and they're actually the margins that are typically 2 times the margins that you'll get in the ultra space. That's where the fee debate is broadly. Digital, again, puts some democratization into that. Now, the debate is whether digital can make fees in financial services really cheap. Are we going to get to an EasyJet scenario for private banking? Or a Ryanair scenario, for example, where you start to realize after a while that it can't be, a £10 trade works. There's got to be some pluses onto that for other activities. But what it does do is helps the industry realize what are they charging for, in what areas, and what's the price for each individual action, which is historically not how the business has worked. It's all been wrapped up into a single price.
What do firms need to do to make better margins in this business, or is the reality that they won't?
I think the second part of your question is an interesting one, because what is an acceptable or realistic margin? Cost income ratios globally, from the work that we do, sits at around about 73%. Okay, and in various parts of the world it goes up or down, but very rarely goes much below 70. Asia is actually middling at around about 83-84%, so it's a more expensive market, so lower margin. In fact, most institutions, if they were absolutely honest about how their books are managed, it's probably even higher, nearly in the 90s. So that's the first thing. We're looking at margins that are between 10 and 20%. Is that where it's going to stay? Is it going to improve, or is it going to get worse? If you look at the investor reports and the shareholder statements of most of the global listed banks, they were all claiming a plan to get down to 60% cost income ratios. Now, that will work in their home market, particularly because they've got large franchises. If you look at, for example, UBS or Barclays in their home markets, they will actually typically enjoy that. Standard Chartered potentially as well. But when you go into an international market, that's very, very unrealistic. What we're now trying to do with some of our clients with white papers to say, actually, imagine a world where you're always only going to have, at best, 10% margin, at best. If you're in any other sector, wholesale consumer product sector, that's a very, very good margin, but you have to be a scale-based business. If you can't get scale, you won't be able to sustain that type of margin. That's a really different mindset for the industry from where it was and where it is in terms of some of the leadership right now. I don't think it's going to be a 40% margin business. The way the industry is responding is doing 2 things. One is many people mentally at the board are saying the way we're going to get this margin is go way, way upstream, because we can get big tickets and theoretically get margins. Well, we know that doesn't happen, but that's what they're trying to do. And the other is to go completely out of certain markets and go scale, which is, we think, the right way to do it. They're all overlooking, and it's not because it's the only thing on the books at the moment, they're all overlooking what digital can do to help either put a block on margin slide or indeed increase margin. And actually in some of the activities in the US that we have with some of our clients, and also some of the research we see, the US market is actually being much, much more comprehensive about where digital will help the margin decline.
Seb, how can firms use technology to enhance the client experience?
It's sort of been a riddle that the financial services market is poor on technology. In fact, financial service market is one of the most advanced technology sectors in the world. It's just not harnessed it for the client experience. So it's a very technologically driven industry for the manufacturing and execution of financial instruments, but it's not very technological when it comes to the customer engagement. That's what has to change. In the context of that, then you can learn from other sectors, so the airline sector, the e-commerce sector, any number of sectors you could choose on. The medical sector is a very good example of what they're doing with private clients in very, very sensitive areas of their lives, and we could take some of those learnings into the financial sector. Those are some big issues. And when it gets down to the more particulars, I don't find that the private banking industry has quite understood what technology means for the customer engagement when it comes to day-to-day activity. The typical response to the industry is to say, well, this is a CRM problem that we need to solve. We need to better know and record the issues with our clients. True. But the research shows us that clients are actually using financial services in a much more engaged way. So they were actually using it as a shop front. Work we did last year would indicate that in Asia, clients are engaging in their wealth management every 5 seconds in the context of the Asia Pacific market, and they're engaging in it through the digital channels. So we have to ask the question, are the financial institutions here actually equipped to meet that demand? And the simple answer is no, not yet. That's not a criticism, it's just a reality. And it's an opportunity. It's a huge, huge opportunity if you consider the growth of the wealth and in this market region particularly. And their route to market is going to be through digital. It's not going to be through the manual channel.
Given what you've just said, that raises the question, why do you even need a relationship manager?
There are skills that don't get delivered through a Boolean search on Google, and that require a personal contact. It's an emotional task to manage your money, that you need reassurance, you need a lot of psychological support, you need a consistency of personal contact to make you feel confident to make the risk-based decisions that you want to make. Can that be delivered through a digital channel? Generationally, no. Some generations will not feel comfortable by doing that through that route. It may well be the 5-year-olds of today, when they're 35 and 45, might feel very comfortable, and there might be more equipment then in order to do many things digitally. But right now, we're still in that mixed world of both. And I don't think it's unreasonable to think that a relationship can be delivered through manuals. But what I do feel is unrealistic is this overweight importance on the private bankers that we see today, many of whom are not sentient to customer behaviors and linking that to the business requirements. So they will take business that isn't actually good for the business, but they think is good. That's a confused area, but it's broadly an issue that the relationship model is going through. If we look back in 10 years' time, probably its biggest revolution in terms of how it interacts with customers, which is exciting. And it's very, very key that it's not just an Asia-based issue, it's a global issue. Every single market we travel to, the same issue gets arisen. There isn't a single market that's separate from this. And it's not unique to private banking, it's the same in the retail space.